Hello. Welcome to KP Data Investing channel. Following our last video discussing the reasons of why we bought Footlocker, the stock tanked nearly 37% in one single trading day after the release of annual financial report. In fact, we are researching other company and planning to release the video soon. But since this seems to be quite of a concern, we decided to make a quick update. Here in this video, we are going to share some of our observations. And most importantly, in the end of the video, we will share our proof of averaging down the position of the stock in this decline, showing that we are putting our money where our mouth is. We believe the significant drop should make our thesis even stronger. Without further ado, let's dive right in. The company announced their fourth quarter and full year results on Friday. The stock tanked immediately right after it. Among all the numbers and wordings, we think that we should put our focus on the most important announcement they made first. They announced a 33% increase in dividend and a new $1.2 billion share repurchase program. It's not the dividend that caught our attention, but the amount of share repurchase program. The board has authorized a new share repurchase program for the repurchase of up to $1.2 billion of Footlocker's outstanding common shares. In case any of you aren't aware what this amount means, check out their current market cap after closing on Friday. Their market cap is now sitting at $2.9 billion after the massive crash. Imagine the percentage of the amount worth of buybacks to their market cap. Dividing $1.2 billion to $2.9 billion, they are repurchasing more than 40% of their outstanding shares. Are you kidding us? 40% of their outstanding shares will be repurchased, and this has been agreed and authorized on the board. But the stock price still tanked for nearly 37% on Friday. This is just simply absurd to us. Does the company have sufficient amount of money to complete the $1.2 billion of repurchasing? The answer is yes. Looking at their last 12-month balance sheet, there are more than $1.3 billion in total cash and cash equivalent. That is more than enough to execute their share repurchase program of $1.2 billion. Also, as mentioned in our previous video, they are roughly $473 million estimated free cash flow. If we take $473 million divided by their current market cap, this will bring us up to at least 16% free cash flow yield. That massively boosts up our confidence in averaging down our position in Footlocker. Both 40% reduction in their outstanding shares and 16% free cash flow yield provide us a strong ground in buying in more share and averaging down. More so, they just reported their total shareholders' equity of $3.2 billion in their financial report, which is also below their current market cap. This gives us a below 1 book value per share. Below 1 book value per share means that the stock price is trading at a lower price relative to the value of the company's assets. However, how come the stock fell sharply after announcing their financial report? There are mainly two influential factors. First, they issued a weaker forward guidance in 2022 than anticipated. Before getting touch on this, we would like to bring up a question asking whether we consider Footlocker as a value stock play or a growth play. Our answer is a value play that could potentially bring a turnaround in their stock price back to the historical average in the past 5 to 10 years. The below average on PE and PS ratio was discussed in the previous video. If interested, a link to this video will be in the description. Since we never think that Footlocker could grow their revenue and earnings per share in a rapid pace, same as the tech stocks. We think that the market has been mispricing the stock price, particularly given the company just announced their massive repurchase program. Now let's take a look at their 2021 financial year results. The revenue jumped 18.7% from $7.5 billion to $8.9 billion, which is perfectly good for a value stock. Second, without much of an increase in their cost for the entire year, their net income increased more than double from $323 million in 2020 to $893 million in 2021. The company also reported an increase of 179.5% in diluted earnings per share, from $3.08 per share in 2020 to $8.61 per share in 2021. We think the company is exceptional based on the numbers in their fiscal year 2021. In their weighted average diluted shares outstanding, they continue with their reduction in share outstanding, boosting the valuation metrics on share basis, such as earning per shares. Forward-looking, is the forward guidance that bad to us as investors? Our answer is it depends on how you position Footlocker in your portfolio. Value stock or growth stock? As said, we think of Footlocker as the value stock play that could turn around back to historical average. They estimated the revenue will decline about 4% to 6%, which will be about $8.4 billion in sales for the fiscal year 2022. While their earnings per share is estimated to be around $4.25 to $4.60 per share in 2022. The price of any stocks is in future discounting mechanism. Using their closing price, $29 per share divided by their estimated earnings per share in the low end, $4.25 per share, this will give us a PE of about 6.8. We got to ask ourselves, if a company announced a 40% reduction in their outstanding share repurchasing program, and with 16% free cash flow yield worth the PE sitting only at 6.8. Even using our developed trading system, factoring in all the future numbers, such as revenue and earnings per share, the stock price is still trading well below their historical average. Plus, the company reported their EPS close to that range back in 2018 to 2020. Everyone can check their historical price. The stock price now is trading well under the lows of those years. The second reason why the stock tanked is that they expect none of its vendors will generate more than 60% of total purchase for fiscal year 2022, down from 70% in 2021 and 75% in 2020. This leads to a question: does minimizing the influence of one single vendor bad news to us? Footlocker is planning to reduce their dependence or reliance on one single vendor to generate their income source, bringing in more brand and category diversification efforts. We don't see how this could be a major impact to the company. They are hoping to find multiple income streams to generate the company revenue and income. This means that the company is hoping to invest for long-term growth and diversify their portfolio. This should be the same to us as investors. We have diversification in our portfolio too. Also, most importantly, they are not completely banning, sharp-cutting all their purchase from one single vendor. They are doing this in a gradual manner, from 75% in 2020 to 70% to 2021, and now 60% in 2022. There must be transitional period for the company to work out other source of income. And they are transitioning gradually and slowly that can keep up with their current performance. Because of that, we don't find this reason to be valid for explaining the significant drop on Friday. We understand that some investors must be panicking about the significant decline. But eventually, we got to ask ourselves, do we know what we are doing and have confidence in our trading strategy? Obviously, to us, we are totally well aware of our action and we know that there could be flaws in every strategy. That's exactly why we said we will average down if the stock trending downwards from our previous video. Yesterday, we bought another pile of shares in Footlocker at $27. Same amount of money buying in for more shares. After averaging down, the stock is only down less than 15% in our portfolio. We are long-term investors, and that means we have the time to see the stock to deliver exceptional return to us. One thing that we learned during the past buying stocks is that we need to know our limits, and things could be out of our reach sometimes. Remember, we should be happy that we can now use the same amount of money to buy more shares as long as we are well aware our trading system and what we are doing in the market. We always have a certain margin of safety and rules in buying in stocks. We first evaluate the company and calculate their reasonable price. If we find the stocks interesting and trending below their fair value, we will enter the market and continue to average down our position as long as they are in decline for a certain percentage. Averaging down under a certain price that we find the stock is mispricing. We did not go all in at once. And this stock is not the only stock in our portfolio. Footlocker only contributes to a small percentage of our total portfolio, not above 5% of our entire portfolio after averaging down. We have huge confidence in our trading strategy and trading system. Even the release of recent report and significant drop. This gives us an even stronger conviction in our thesis and strengthen our reasons for buying in Footlocker in the first place. We hope that this video can share our action after the stock plummeted on Friday. We only offer our insights in how we evaluate a stock and share our research. Thank you for watching. Press the like and subscribe button, hit the notification bell if you find this video useful. You will be notified when our latest video is uploaded to the channel. Leave your comments below if you have any thoughts about our work. We hope to continue sharing our findings in the stock market. Investing is for everyone. I will see you in the next video.